Hello, everyone. Welcome to Purplle by CoCreate Ventures at the PES University, or what is well known as PES Venture Labs. We are a fund and a place that supports entrepreneurship. We have funded 26 ideas from students to become entrepreneurs, and some of them, four of them, are going national and global scale. By the way, I'm your host, Vishal Krishna, and I am pleased to have Ankur Bansal here. He's going to bring us a very different perspective. All of you so far have heard of venture capital. But what is venture debt? That is another way to actually fund yourself and grow your company. And Ankur is going to tell us about it. Ankur has been with Citi and JP Morgan in the past. Okay, he set up this company in 2010. They have funded companies like Spinny, Udaan, and OYO. And you know, all of these are unicorns. Right, Udaan and OYO are anyway unicorns. They have provided rupees 1,650 crore as loans and have had about 65 exits. And the average ticket size of that funding is 15 crore. That's pretty decent when you startups are looking at it. By the way, venture debt can also go to technology companies, and Ankur will tell us about that. Ankur, it's great to have you here. Thank you for taking up on the offer to come and talk to students or students listening in. And Let's start with this, right? The basic question would have to be, what is venture debt? But I'd also want to ask you, you left Citi and JP Morgan. You could have had a great career there, but you chose to start up. Why? Let's start there.
Yeah, so I saw what my boss was doing. I hope he doesn't listen to this call, but I saw what my bosses were doing 15 years from now. And I didn't think I could do that day in and day out. And that's where I thought about, starting up. So it was, very much of an entrepreneur's journey. That time, nobody thought about being entrepreneur. It was not a sexy thing, for a lack of better word. Now it is like the thing to everybody has to do it. But it's obviously not meant for everyone. You need to have a very different kind of a skill set, ball game, mentality, characteristics, stars to be aligned. A lot of things have to fall in place. So yeah, it's been a good journey. So that's where we started off. It was earlier on more of an advisory practice, helping mid-market companies to grow. And 2013, 2014, we started seeing startups coming in. We were working with many companies. Some of them are, one of them is OYO, which was also earlier for us was a advisory client. So I was helping them on the M&A side, etc. So it was still very early days for them. And quickly we were able to, using our network, able to bring in family offices, capital, and transform to a fund management business. And since that point of time, we saw debt was still a very early concept, and still many people are still picking up on how that concept works. We were able to transform to be one of the third players in that segment back in 2016. Using our NBFC vehicle that we had set up at that point of time, and now obviously 6 years into it, it's been a very fulfilling journey. We've been part of the ecosystem. Feels great that the entire ecosystem has really grown from leaps and bounds, and today's founders are very different from what we were interacting back in the day, right? So it's no longer a niche play. Being a startup, it's become mainstream. Debt was alternative, that has also become mainstream now. Obviously new forms of debt are coming up. So it's every day is an exciting day. You wake up to read about other 10 things which have happened, and in some places you are part of it, some stories are not part of it. Then you are always, either missing the bus or you're part of the bus. So it's a very exciting journey for us so far. Very fulfilling.
No, it's fulfilling indeed, and I'm glad to have tracked that journey as part of my previous avatar as an editor of the organization, another famous organization. I'd want to know two things: venture debt, venture capital. Two very different things, because most of the audience on this platform will be students and early entrepreneurs. Let's start there. How do you differentiate between the two? I know the difference, but let's start with your feeling on, because you said after 2015, people started accepting venture debt as a vehicle, right? And it's also when startups realized that they could also keep equity in many ways. At the growth stage, of course, VC money, I have nothing against them. They should come in at an angel stage. Very important, guys. Ankur will draw out those differences. Ankur, over to you. What is venture debt? What is VC? They can coexist.
Yeah, they're supposed to coexist. Venture debt on its own is not a product that really exists in a large marketplace. It can be a very small markets as such to look at, but venture equity, as we know, last year almost $35 billion came in, and almost 10 to not even 10%, 5% of it was possibly the venture debt market. So it's a very small component of the overall ecosystem. It's not something which is substituting the venture part of it. It's actually a complementary to the entire story. So that's very important to understand. It's not that you can just make your startup. If your startup is on the perspective of, looking for growing on the basis of investing in technology, looking to invest in customer acquisition cost, and looking to burn finally, a venture debt can be a small partner in that. It cannot be the only way to grow. So that is one very important thing, because debt as a product, as we all know, has to be returned, right? So you can only return from it only from 2-3 sources. One is either you make profits, which obviously is easier said than done for startups. Second is you do the next round of funding. So that again boils down to equity. So debt is still a very niche play. There are very specific situations where venture debt players come into the picture. Venture equity guys are investing in the company, looking at a very long-term horizon, right? So they are investing in an idea stage. They could be investing at there's some kind of a product market fit, some technology is ready, or it could be coming at where already there are some few customers for it, or already it's at the growth stage. So for every stage, as we keep calling it, from early stage to pre-series A to A, B, C, D, and now today we're talking about even X, Y, Z. So there is enough equity guys coming in with different kinds of check sizes and different kind of return expectations for their investors. Venture debt partner generally comes in when you have a serious amount of equity money coming to the company, right? Because we are not coming and backing ideas. That's very first, right? So we are backing ideas, but that is not at the idea stage. To be more clear, there is a product, there is already a customer who's paying for that product. So it's already at a stage where you're not still figuring out who's going to be my customer, what is the price at which I'll be paying, whether somebody will be paying for it or not, is there a market for it or not. All those issues have been solved for, and there is a venture equity money has already gone into the company. So when your venture equity is gone into the company, then people may ask, why do you need debt then? Because already I have equity, why would I go and raise debt? So that is where the things start becoming very interesting, because each company goes through a very different life cycle, right? So before starting off the call, we were talking about I have funded a unicorn. So unicorn also, who has raised maybe possibly over $1 billion, has taken debt from us. And we are also talking to a company which has raised only $1 million of equity, also is raising debt, right? So each company at different stage of its life wants a different kind of objectives. And that's where, a venture debt player can become a good partner to have. It's like, one is simplistically, people want to not dilute, right? As you would read, in many of the larger funded companies, most of the big guys who have gone for listing have single digit ownerships. So as you keep growing, you obviously have to keep diluting. And at the beginning, obviously dilution, you do not really matter that much, because, it's still very, very early days. You don't know where the startup is heading. But as you go from series A, B, C, you start realizing the potential of your company. And at that time, every half a percentage point also matters a lot. And that's where taking debt to avoid dilution, and that's where it becomes an alternative, non-dilutive product. Becomes a very interesting product to look at from the perspective of the founder. Second, then there are other benefits which start coming in, is that as companies we are aware of, and some of the listed companies have been in the news for being a loss-making companies too much. When you have a debt in the business, then you start figuring and you start taking the entire perspective of fiscal disciplines, or when you have to take debt, you have to return the money, right, on a monthly basis in a form of EMI or interest payments, etc. So you can't be running that operations like you are not running a cowboyish firm, right? You have to return the capital. So you need to have your business plans, your cash flows very much under control to be able to take care of it. So a lot of the VCs encourage that you should take some debt, small percentage. It's not like the typical finance debt to equity we are taught about. 1:1 debt to equity is a very good situation to be in. Even 1:2 is also very good to be in. In our case, it's the other way around. If a company raises 100 rupees of equity, we give 10 rupees of debt, right? So it's a risk averseness is exactly opposite of the typical equity, so a typical traditional company perspective, because a traditional company will have cash flow. It has EBITDA, you can do debt to EBITDA, you can do a lot of the DSCR calculations that you learn in the finance math class. But in this kind of situation, the call is not just on the financials. That financials is the beginning. You start getting to understand whether this is a business that one could take a call on. There is certain kind of data to back whether this business is how it's going to look like. So the equity money gives you a certain kind of data. Then you have the actual revenue into the company and the burn that gives you another data. And then you, as a lender, we have to actually understand the story behind it. It's not the typical private equity and traditional bankers are very different, right? So, but venture capitalists and venture debt guys are very similar, because we have to finally understand the story behind this company, the founders, the business, the market size, the competition, what is going to happen to the business 2 to 3 years down the line. So we become very similar in a fraternity from that perspective, right? But a typical public market investor or a debt player or a private equity guy may have very different perspectives on looking at the same traditional company. So that's because we need to be able to speak to the language of the founder. The founders do not speak the language that our possibly fathers used to talk about, or our forefathers used to talk about, because the language is very different now. We're talking about CAC, we talk about TAM, use so many abbreviations which a typical lender in the market will not understand what they're really making sense, right? Because they finally come down to a templatized kind of lending. So that's where specialist lenders like venture debt guys have come into the market. We are 4-5 of us who are really there, obviously having to get to work with multiple kinds of companies. And with various companies, different use cases come in. Some companies are very capital efficient.
You're almost like reading my mind. I'm trying to structure my next question around that. How would people use the venture debt, right?
Correct.
Let's give it a little flavor. You funded everything from SaaS to
B2B,
things like Udaan, right? B2B. Let's keep it neutral. You've done sure. B2B, B2C also. So what are the different requirements? Let's say I'm a SaaS company doing 500K revenues per year, but I need venture debt now. What would I typically use it for? You can give a color. Correct. And now I'm a $10 million firm. And then obviously once you're 10 million, I know the needs are different. We could, and even the larger ones would have the same need. We could talk about why they use venture debt.
Sure. So typically a early stage SaaS company needs money because they have a contract book they want financing for, because they have to invest early on, or they have receivables because their money is getting stuck in receivables because all enterprise customers will pay them after 2 or 3 months. So every rupee that they are investing into the business and growth is happening, the capital getting stuck in receivables. So that's where something like a 200K line or a 300K line would become very, very exciting for them, because that money can be utilized for growth and they can finance their working capital for the perspective of a receivable finance. So that's one use case. Second use case is there may be a business, because a lot of the SaaS companies don't really have working capital. They just get paid maybe 6 months in advance, or 9 months in advance, or a quarter in advance. So they have a negative working capital cycle. So that what they have an issue with is that, can I delay my financing for another 6 months, because I'm growing 10-20% month on month. Right now my run rate is 70K a month. If I go to raising money from Axel Sequoia, I want to raise it at maybe $100,000 kind of a situation. So my multiple will change, right? Because every 6 months I will be possibly doubling, right? So at that situation, I would like to take debt to extend my runway. So if I'm burning only $10,000 a month or $30,000 a month, if I get another 100K, I get another 3-4 months, and that just makes me a good spot to be in, so that I can utilize that funding for my growth and go on a better valuation with it. Some of the times what happens is most of the VCs have a certain kind of target, right? If you have not reached 1 crore monthly billing, don't come to us, right? Or if you have reached only 100K, touch at least 200K. So a lot of these VCs come up with their own, expectations of, what's the target business should be. So debt can help you reach that, because you don't want to dilute so soon. So you can be a little greedy on your valuation from that perspective.
That's a great point you made, because like I said, at the university, we funded 26 startups, and some of them are, at least 5 of them are on growth stage. And they've raised seed money, which is good enough, but they can also take venture debt so that, they can make the product go faster, maybe, because they already have some billing happening. But you are right, they get paid 2-3 months later. For a B2B startup, this is perfect.
Correct. But
there has to be a cash flow, right? They have to know that they're getting paid.
It cannot be at concept stage, not only on the business plan stage, not only on the Excel business plan stage. So typically you won't get mainstream debt. You may get debt in the form of, you can get capital in the form of debt, that some angel investor may structure it like that, but it will not be the mainstream venture debt that players like us are involved in.
Now I'm curious about this. We had to talk about the $10 million, right? If I'm a $10 million company, how do I use a venture debt?
So I think the use case will remain the same in both the situations, because if you are a B2B guy, still receivables is a problem, or you're a greedy guy, you want to get a better valuation, so you will delay your entire round. Or there are situations where there's a third scenario which I can come up with, is where the company is close to profitability. So they are like just burning maybe $30,000 a month. So if I delay it by another 6 months by taking debt, and I can become EBITDA positive, then that also makes a big difference in evaluating a company which is a loss making versus a EBITDA positive company. So that's another scenario that we have seen in the past, that people think that I can utilize it. And if you're 100 million, I'm just like sort of going to the next level. Somebody is not even 100, maybe $50 billion kind of a SaaS company. They are doing acquisitions today. So a lot of these guys want to acquire another player in the similar segment, or want to acquire players in the complementary space offering different products or services. So acquisition financing is another segment where debt is becoming very, very prevalent now. So as they want to grow quickly, acquisition has become the flavor of the season, where many of the SaaS companies are adding either for the complementary products or a customer base that they can sell the similar products to. Could be an offline business customer that they can add to it, or maybe geographically expansion as well.
No, there are audience questions. Let's take some questions, right? This is the founder of Just Books in Bonamia, and he's also an angel investor, Suresh Narasimha. He says, how many startups have you helped raise money? What were the level of these startups, right? But let's start with that. And what is the average raise for these startups when the deal happened? That's the first question. We can break it up. How many startups have you helped so far?
Yeah,
okay, go for it.
Yeah, so I think almost 70 to 80 startups we have funded so far.
Okay.
And
the level, what level were they at in terms of revenues?
So it's typically 60% of my portfolio would have raised before our funding at least 100 crores of equity money.
Okay.
So that 100 plus. So that 40 would be below between 25 to 100 crores.
And the ticket size, how much raise, and why did they come to you, and why did they come to you for the same reasons you mentioned?
So some of the reasons I mentioned remain the same. It does not change. Extending the runway, doing. I'll complete that. So maybe complete that. The typical ticket size that we are doing is between $2 to $4 million. That's between 15 to 30 crores, a typical ticket size. But we do sometimes very small, like 2 to 4 crores also, very selectively, and very selectively above 50 crores where you are doing like 75 to 100 crores kind of a transaction size as well. So other use cases that come in where capital would have been utilized. Another important one is, as you may be aware of, Vishal, is that many companies keep doing bridge rounds, right? They keep doing insider bridge rounds because they are not ready yet to raise a very large equity, or they're not in the position where you're not in the flavor of the season. So, but the existing investors are very comfortable with the company, and they're putting in a small kind of equity so that the company keeps growing or keep growing to the next level. So that point of time also venture debt becomes a very good partner. So if somebody's put in $3 million of insider round, we put in another $1.5, $2 million along with, so that $5 million becomes a very good kitty for the company to grow for the next 9 to 12 months, and again then go and hit the market. Because sometimes you are hitting, most of the founders are always in the fundraise, right? Whether you are a unicorn or whether you are a company you just started off yesterday, your founders are always constant. Out of 12 months, 9 months they're fundraising, right? So 3 months they don't get to fundraise because they would have just closed the round. So when they're only fundraising, it becomes important for them sometimes to show that they have grown from the last conversation. So that's where the insider rounds become important, and a venture that helps them to get lesser dilution at the same point of time.
I think Suresh also leaves a nice question, and he says, how do you look at the criteria? Is it cash flows? Is it asset backed? You get what I'm saying? And how risky are these two propositions?
So I think both are important. So when we look at a transaction, our typical due diligence continue from the first call till the disbursement, almost 30 to 45 days of study goes onto the business. So it's not like we are not like some of the larger growth guys you keep hearing in the market that you do a one call and you get the funding. It takes generally much longer for us to be able to form a view, get our approvals in place, and you end up funding a company. So that 30, 45 days, we are evaluating many things, right? So you are evaluating the business in very threadbare kind of a way, understanding it's beyond a concept, right? There are customers who are actually there, not just metrics, right? Because we are not, we don't get excited by metrics because we are not an equity guy. For us, valuation could be X today, could be 10X tomorrow. And then again, it can be X divided by 2. For us, the company's sustainability is very, very important. The company offering its services is very important. So from that perspective, finally the revenues, the quality of the revenue, the quality of the unit economics, the quality of how they are able to service the customers, how much the customers are coming again, what is the quality of the repeat customers, all those things become very, very important for us, right? And then from that perspective, you have a great business, but sometimes you've seen receivables are like stretched for like 6 to 9 months because your customer is government, right? Government of India. Absolutely. So then that is a very different business versus somebody who may have half the revenue, but your customer is paying you in advance, right? So we will obviously go not for something that I see on my balance sheet receivable and get excited about it. Oh, I have receivables, I get happy. But the quality of receivables is not great. I'll go to a company which may not have any receivables, but it's collecting in advance. And I know that they are at the same time could have the similar metrics, right? So some of these very smaller, minor nuances for us become more important, that this company is going to be dependent on equity? Is it dependent on itself, or it's something that is very, very unique and innovative in its marketplace where it is standing?
Okay, lovely. So there are a couple of, there's an edtech company here. His name is Puneet, and he says, he's generating revenues about 1.5 crores ARR apparently, and he's got a lot of deals signed up with a lot of universities. The edtech company for universities. Like you said, the invoices are generated, but they take 2 months to pay off, right? Would you fund them on the invoices, or is it a different kind of a criteria?
No. So we would fund on the invoices, but unfortunately, the company is very early for us, right? So we would end up funding a company where the monthly run rate is 1 crore. So it's at this stage of the company is what a challenge is, not necessarily the concept. So invoice level financing is definitely one of the other products which have come as outside of venture debt. But there are many players on the receivable financing which have coming up. And what happens is in receivables also the quality of receivable matters. You have an Amazon, Flipkart invoice is very different from having a SME company as your invoice, right?
Risk is different.
Risk becomes very, very different. So if you are like a seller on Amazon, you have to get money from Amazon or Nykaa, you can discount it from most of the banks. But the moment it is like some XYZ SME customer who has no rating, etc., then for you to, even if you offer 18% return, nobody's going to discount it. So it's a problem of everybody wants to fund high quality customers than funding very, very relatively lower rated kind of a customer base.
Okay, there's a logistics company called Frizzle, and it's Ananta and Abhilash. At what stage, for example, you said 12 crores. Once they're getting there, and they have a lot of deals with these energy companies, logistics companies, and the timeline to payment is longer, right? So is 12 crore a number that you stick by? Even if you're closer, you get 10 crores, 8 crores.
Yeah. So we are not like a bank. We are not like a bank. It is like cast in stone. What is important is typically if I've done more than 70, 80 startups, all these guys are backed by VCs, right? We have done only one company which was not backed by a VC. So what happens is most of the bootstrap companies are struggling to scale, right? We don't want to end up funding companies which are finding difficult to scale because you're loss making, you don't have capital access. So servicing of debt will always be challenging. So you want to fund companies which at least there is a good institutional investor behind it. So an institutional investor ensures there is a certain kind of process, systems in place, certain kind of corporate governance is followed. And more importantly, they put in money behind it and there is a story which can become possibly a larger story. So if it's a bootstrap company which has been there for last 5-7 years at the same 1-2 crore level, then it's not venture-ish, right? So our name is venture debt. It's not the typical debt. Typical SME debt, then there are many other companies potentially out there. Many fintechs are out there who looking to fund some of these SME kind of stories. So that's a little bit of a demarcation between them. But invoice level funding is something not a challenge as such in today's time. If you one is looking for, because there are multiple people out there looking to bank invoices, depending again on the quality of the invoice.
Okay, I want to quickly ask you last year. And correct me if I'm wrong on the numbers. This is based on what I've researched. You funded about close to 80 million last year, and apparently there were 20 transactions last year, and you've registered a 2.5 time growth in value, right?
Yeah.
Has that been a consistent growth for you in the? I'll say from the startup world, say from the 2015 onwards. Is that the steady average that you've maintained?
No, I think in between there was not significant growth. I would say from the period of two years of COVID, right? So I don't think we grew at that point of time. We would have maintained the same steady disbursement that we had. But last year was definitely one of the most highest years of growth, right? So there's no point comparing the first 2-3 years. Of course, we're starting from zero, right? So anything you start from zero is going to be like huge multiple of growth. But if you see around IL&FS crisis, which happened in 2019, post that, then suddenly COVID happened, then 1.5 years went into COVID. And then last year, obviously, FY22, things changed the gears significantly. Then our gears also started changing. So the real growth serious growth, I would say, has happened last year. Between was consolidation phase. Starting obviously was a good growth phase because we started absolutely from zero.
My most interesting aspect of your investments is it's very different. The fact that the way you raise is also different. You go to ultra HNIs mostly.
Correct.
Very different model. And are they okay with such a, they usually go to these funds that give them returns, but this is also a great asset class for them to invest in.
Correct.
Talk about that period. Now we can cover your history. You started off as a real estate development fund.
Correct.
And then moved into SME, moved into a startup and corporate, of course. I'm curious for that journey of how do you raise and how do you continue to raise? Is it, in the debt cycle, we say new fund 1, fund 2, fund 3, but in your case, you wouldn't call it that, right? It wouldn't be like a fund 1, fund 2, fund 3.
Correct. So we started off as funds from the real estate fund perspective. And what we realized during the period, first was the first real estate fund in 2014, then we started off our NBFC in 2016. And during the first 2 years of NBFC, we were doing real estate plus venture debt from the same book. We did some structured finance also to growth companies. Then we started realizing that real estate is not the asset class which should be in NBFC, because NBFC is regulated by RBI. It has very different connotations, because even 3-month delay in real estate is, you all know, like I think everybody on the call would know, 3-month real estate delay is like nothing, right? Because there won't be any project that anybody would have come across. Like 99% projects will be like delayed beyond 3 months for whatever timelines people would have offered. So 3-month delay can happen in servicing. So it's not a great vehicle to be in. And we were obviously running a fund. And then we decided, let's continue running real estate as a strategy in our fund business itself. So now we are onto a third fund. So we went to fund 1, which was 160 crore, then fund 2, which was a 320 crore fund. And now we're onto 500 crore fund, which is fund 3. So we're just running real estate outside our NBFC business. And we started seeing, but at the same time, the venture park business, which was started off in 2016, 3-month delay is a long period of time in startup. As you know, it's like in 3 months, a lot of things change. So we didn't come across situations where many companies ended up, delaying their servicing or, delaying their payments beyond 3 months. So that quality of book was extremely good. And most importantly, we've gone through last 6 years have been the most difficult cycles that anybody could have gone through, right? And been building a business, whether you're talking about demonetization, whether you look at IL&FS crisis, whether you look at COVID, Yes Bank, you can name the number of crises, the fingers will be less. So from that perspective, this quality of book, and I don't think it's alone standing for BlackSoil, I think other venture guys also would be probably around the same quality they would have seen, is that because if you underwrite well, you're picking up good customers, good startups, they're growing well, servicing of debt is generally not been a challenge. And we have had, if I've done 120 deals, we have had only one write-off in this period of time, right? So you hear startups, you all get scared, right? And most of the people say, if I have to put money in startups, there'll be write-offs. I've had only one write-off. So that sort of, and I'm saying their companies would have obviously delayed.
Why did that write-off happen? Since you bring it up, I just want to ask.
So that write-off happened because IL&FS crisis happened. It was a fintech company. And they had at that point of time only changed their business model. So, and it sort of, things didn't go their way in terms of the person who wanted to fund them also, picked up, sort of snatched, what I would say, that withdrew the term sheet, withdrew the documents at the last level. So, and you are at a different valuation expectation also in sometimes in life, right? So when things go wrong, all things go wrong together. So then the company had to unfortunately shut down at the last moment. But the learnings, there were a lot of learnings from that entire case, right? Because you see how something which was a hot or really one of the hottest companies that out there one point of time suddenly loses sheen. Suddenly nobody wants to fund you. Suddenly there's no strategic guy also interested at even, at the book value of the company. So things can go awry very, very quickly in startups. So you can't get too excited by valuation, as I was saying early on. If it's sustainable, then it will go through cycles and you will be able to see business finally evolve, even if you go through difficult times.
So these HNIs that we talk about, they like this as an asset class.
So yeah, yes, correct.
So 18 months, 2 years kind of return.
Correct. So what we have done, we have like 2-3 different products for HNIs. One is direct, they can come into the direct transactions. Second is they can come through the fund route also. We have a fund route which is set up for HNI, so they can invest directly in our fund. So you get diversification across transactions. And third is people who don't want to do a transaction at all with startups. They fund directly at our NBFC level in the form of NCDs. So that is an exposure they take at the promoters of BlackSoil or the management of BlackSoil. They are not taking specific transaction exposure. So we have like 3 different layers of raising of capital, ranging from just direct exposure to BlackSoil, to direct transactions, to direct funds. So that actually has really helped us energize a very different sleeping pool of capital, for lack of better words, because a lot of these guys had never thought about venture as such. Most of these guys still don't have much exposure to venture asset classes, even though they might be very large exposures to equity markets or real estate, but not much as such to the venture debt or venture equity as well. Venture debt becomes a good way to start for them because it's a risk adjusted product, because you're funding for 2 to 3 years only, your money comes back faster, and you may even have equity upside in the form of warrants, which may give you a booster if your returns are good, right? And still you're looking at a return of 16 to 18% IRR, which is very high yield in nature, right? In today's time with the low interest rate environment, very difficult. If you look at your FDs at 4-5%, it's very good returns if you can get at 16%, right? So it becomes a very interesting talking point. And of course, in the last 18 months, suddenly people have realized startups is no longer just a valuation story. People are actually doing businesses. Everybody around them, include themselves, would have started using digital stories, digital adoption through the roof for their businesses, or their young generation of people coming into their families would have started using technology in a very different way. So the entire reception for startups has started changing in the last few years.
Okay. My question to you is, you invest in B2B, enterprise SaaS, fintech, health tech, agri-tech, ed tech, clean energy, and D2C. These are some portfolios that I have seen.
Correct.
Without naming any company,
yeah.
which vertical or which horizontal generates the best cash and makes you the most money?
So I think money-wise, we have kept the yields for us similar in all the transactions. So it's not like, that one segment gives us lower yield, some segment gives us high yield. It's more driven by the stage of the company. A unicorn may end up giving us a lower yield, and a stage Series A or pre-Series A company may end up giving a high yield. So it is more driven by the stage of the company than the sector. If you look at which sector I like more than some other sectors, we have always preferred a B2B kind of a business. So B2B could be in the form of SaaS also, could be form of e-commerce also, it could be form of healthcare business also. The reason we love B2B more because working capital is a good problem to solve from through debt, and they are generally a low burn company. You generally don't see, except like very few companies, the B2B companies are not very high loss generating companies, right? So most of them are also profitable already, or they are very low burn companies. But a B2C business, a consumer internet business, has to burn, right? Because you have to go and acquire one customer at a point of time. You have to do marketing, and today's as you know, today you have to do IPL. So that is the only way people see marketing happening. So that is not cheap, right? So as a lender, you don't get happy seeing money getting burnt in marketing and advertising. But of course, that is the nature of the beast, right? So if a business is doing well, you're growing well, you have to invest in marketing. That is your bread and butter, right? That's the only way you can grow. And that is, but I'm saying as a lender, you get happy in a business. There is more receivables, more inventory than, burn.
Ankur, you know what I'm happy about you also? You're able to sit on the table of some of the biggest VCs and do rounds with them as NCDs. I remember, I think you've done one unicorn in one of these deals. And
Correct.
And for you to be in the books of the VCs also, how does such a deal happen?
So I think, as I said, even VCs now want multiple forms of capital. I think after COVID, people realized that you should not just have VC equity partners to depend upon. You also need venture debt partners as well to work with, because at different points of time of a company, different requirements come in. And at that point of time, it becomes very important that they are not just dependent on the equity guys. So even the debt guys are able to chip in, and that becomes a very interesting way for companies to scale as they keep going from step A to step B, or as they keep going from one business plan to the next year. I don't know I think Vishal.
No, I think we're back now. You were saying,
yeah.
Go on.
Yeah. So I was just saying
had a small blip for about 20 seconds. Pardon me. Go on.
Correct. No, so I was just saying that VCs have realized, especially after COVID, that you can't just have VC partners in the growth story. You also need venture debt partners. And I said partners. I've not said partners. So there are multiple. Sometimes you have 2 or 3 of us working together in one of these companies, right? So even though we might be competing at one point of time, we end up working together also at many situations, right? Because the company's growth is much more. So what they have realized is that all kinds of capital is important for growth for a business, just not equity. And a debt used very, very strategically and used smartly can help the business continue to grow. So that's where it becomes very, very interesting for businesses to not just depend upon equity to grow, but also the debt to grow. And if you come at situations and you help venture equity guys out in situations where the business was, struggling for a point of time, or they needed certain problem that gets solved using debt, and you're able to give a very good experience to your customer, right? It's not the typical India mindset of banks, right? We all know if you have to go to a bank and you have to do anything with your bank, except if it's not digital, if you have to go physically, it's a very pain, right? Whether it's a home loan also, whether it's a car loan also, it's not the most interesting experience to do. Unless you are a corporate which has like a AAA, AA rating, you don't get really a very high quality service in Indian banking space. But we work differently. For us, our startups are like a AAA client. So I would like to give them a very good experience, even though I am giving the money. We work in a very different mindset that, you are my customer, I have to give you a good service, right? So even we don't end up working with people, they may come back to us after 6 months or 1 year for working with us. So the experience of working with a lender like us is very different, because you have speed, you have understanding, you have domain understanding, and you can create product solutions which a typical bank cannot. So keeping all this into together, and you providing solutions, and you are one of the few players in the market, so automatically VCs become good friends in your entire growth journey.
Okay, there's a question from Meda. She says, how do you, because you're scaling so fast, is most of it, do you use technology to understand and filter your potential investments? And what is some of the technology that you use, or is it mostly looking at the books, sitting down with their CFO and saying, okay, we like your company? How are you planning to scale this up as a platform, BlackSoil as a platform? And following it up, Kavana says, what does BlackSoil mean?
I'll take the last one first, because that is something I really like to take up on when everybody asks, because that's a bit of a story. So my family comes from Punjab. So this business I started with my father. So one of the few businesses you will see a father son sort of doing in the venture space. So we started off together back in 2010, as I already mentioned. So we come from Punjab, where black soil, Kali Mitti, is the most fertile soil. So our idea was to remember the roots and provide the most fertile capital / ideas. So that's where the word BlackSoil sort of came into the picture. So you remember the roots, and you remember that it is again, you have aspirations to become one of the other big black names that we know about in the financial services space, right? So that also is there behind it. Coming to the earlier question, which was around how do we use technology? Yes. So there are technologies being utilized right now in 2-3 different fashions, and there are in underwriting. Still, it cannot be completely, technology cannot be utilized, because each business we spoke about right now is very different, right? So it cannot be done by algorithm right now. But we are using various tools. So we use, like, for example, a bank reader software to be able to study the collections of a bank. We use something called Corpository, which helps us provide compliance report for a lot of the companies, because in ROC, we get to know all about a company's history, whether they are doing annual filings, whether Vishal is doing GST filings or not, whether they are having a problem.
Which you will see very soon.
Correct. So those are software which you can just pull up the reports within 30 minutes, and you get full history about the compliance product for the last 3 years, 4 years of those companies. Then we have our own loan management system. So we have like portfolio of more than 70 companies. So you have repayment schedules, you have legal documentation, you have reminders, right? Our job is sending reminders to our companies to pay our debt. So all those things are happening through the system. So we have invested in those things where any auditor can come tomorrow, sit and study any of our accounts and figure out whether what is the status of that loan account. So we can draw up accounts, and a lot of our RBI reporting also happens through that system. So technology is going to be very important for helping us underwrite, but not underwrite them by using the technology itself.
You bought an NBFC very early on in your
career,
I remember that. And when you start pricing for these HNIs, it's not a typical, it's a different format of pricing, right? The interest rate, it's not like you're borrowing from a bank and then pushing this forward. How do you work out the interest rates?
I think it's more about how we were able to negotiate with some of the early on, how you get the pricing done, right? India is all about gut-driven kind of pricing. It's not like driven by I am a X-rated company and I should be at a GSEC plus X kind of a BAPES kind of a rating. It's driven by more about private trade. So we started off at that point of time at a 12% yield. We used to offer. Now we're down to 10% because interest rates have moved down. And finally, it's not about the yield I want to offer. Somebody who has to even bid for that pricing, right? And we've been able to raise more than 350 crores in NCDs from our HNIs over the last 6 years. So that means there is that pricing is something that customers are happy about, right? And we've been bringing the pricing down in the last 2 years. So they would only do it if they feel the business is doing well, right? And they feel market standing. You come to know HNIs have their own way of doing due diligence. It's not your standard way of due diligence, but they come to know their 6 years track history of servicing loans, how you deal with your customers, how you deal with your investors, what kind of data you share with them, what kind of experience you create for them, and what they expect the business is doing, right? So they have their own ways of doing. You cannot say all HNIs are stupid, right? They are an HNI. That's the reason they are an HNI, because they know some things, right? We all on the call are not yet HNIs, right? So they have a own way of assessing things and being able to get comfortable with the credit situation that they are funding to people like us.
Okay, how do you build a team around this? Okay, this is one question that one of them is asking. But before that, there's an important question. I think we should take that immediately. How different would venture debt be different from a loan product from a bank?
Yeah. So on a document perspective, it looks very similar because a loan document is not going to be very, very different. It's just that a security package is different, right? We don't have any plant machinery. We don't have pledge of shares. We don't have personal guarantees. So the document relatively becomes much smaller. It's focused more on the business and the assets around the business or the intangibles around the business. That's where the security comes in. So the loan document changes from that perspective. So this kind of underwriting itself, a bank is not structured around. They need to have a very different credit history to a credit DNA, a credit underwriting mechanism to be able to fund something like this. So that's where most of the banks will struggle to fund something like you, because their internal credit charter would not allow to fund something. You don't have your house mortgaging, you're not mortgaging your plant machinery. So how will I lend to you? On what basis? You may be a company does 10 crore EBITDA and they won't be able to lend to you. I actually got onto a call before you. I was onto a call with somebody who has a 30 crore EBITDA. 30 crore EBITDA.
Problem?
He's not, he's coming to me for debt financing, right? So it's a great place for us to be. And I'm very happy our banks are, in sort of not doing work for them.
So their loan engine definitely says no because of their charter.
Just because of the internal guidelines. And because see, they are also doing trading companies also, they are lending cement companies also, they are lending to steel companies also, they're lending to infrastructure. So startups for them is very small, right? So they have to create something special for them. So unless the top management of a bank thinks that startup I have to really, really focus upon, then they'll create a separate team for the entire, parameters from credit, risk, underwriting, process, everything, right? So that's like creating another bank, like bank within bank, right? So that's a very different situation for a bank situation. That's where I have a 17-member team only underwriting and doing risk for my portfolios, 17, only doing startups. So that means, it's my bread and butter. So that's a very big difference. That's like how you have Nykaa, who's doing cosmetics, and you also have cosmetics in a Nykaa, possibly in a Flipkart or Amazon. But the range of products and the quality and experience that you get in a Nykaa is very different for them.
Interesting. Okay, the team. Like you said, you have you have technology. We answered that. How important is the team that selects startups? Are you the guy who signs off on the final deal, or do you delegate saying, I would trust you?
So what you can't finance business, you have to trust your systems.
Go for it. Tell me.
Yeah. So in your finance business, you trust your systems and process that a certain document reaches you at a certain point of time. The team has done its job, right? But we have a process of, validating it, the transaction at multiple levels. First is at the team, which is actually, the sector team, which is looking at the transaction. They make the note, they bring the recommendation to the management. The management feels okay, they offer the term sheet, we close the terms. Then we take to the investment committee for approval. Once the investment committee says okay, then the transaction gets completed. So it's a back and forth between the investment team and the management team, and then final okay from the IC, as we call it in our terminology.
How big is your team now?
So overall, because if you look at only the team of the credit of startups, we are around 17 members, which is only doing this business day in and day out. But to support that team, we have another 5-member team in compliances and looking at the entire jurisdiction of the structure of, because we have too many funds and too many and an NBFC to manage. And we have a separate 10-12-member team for the real estate and a separate finance team, another 10-member team for that. So it becomes a much overall 40 to 50-member team that we have.
Okay. You've done so well. India is a large enough market as it is. A lot of the companies on the transition abroad, they go from here to America. They want India to be an R&D center. I want to know, is there an international play to BlackSoil? Can you even think of one?
We can think of regions which are coming up on startup world. It cannot be developed markets because debt is well understood there, and they know better than anybody in India, because US, Europe have been in debt. They have been doing it beyond, even before we can think about startup, right? Even before startup started, they have been doing that way before, right? So for them, this product is well understood. They have been able to do many more things. But emerging areas like the Southeast Asia, the MENA region, or Africa, these are the potential geographies that one could look at expanding. But the thing is that India itself is so large, we're not even scratched the surface in India. And for BlackSoil itself, thinking of expanding, setting up a separate team, fund structure, it's like sort of easier said than done, right? So it is more right now, obviously the focus for the next couple of years continue to be in India, because as you know, India is the third largest ecosystem. Why and go and work in new ecosystems?
Okay. Toughest deal that you had to make that succeeded. The reason I ask you this is...
toughest deal which succeeded or did not succeed?
Which succeeded. And the deal that you think would work but didn't take off.
So if you look at the toughest deal which succeeded, so there are like...
We're not going to name the companies. We just want to name the sectors.
No, I'm just thinking. There are 2-3 of them, right? So we had one hospital chain we had funded. It was backed by marquee investors. It was EBITDA positive also. Went into this government receivable problem because one part of the business had government receivables. Had really cash flow stretched. Had debt because it had invested in hospitals. And I think almost for a period of 12 months or maybe a little bit more, they were only servicing interest, not the principal amount. But you know how things change. COVID happened. They had a business on the telemedicine side, and that became so exciting that they were one of the few companies in India which were acquired by a SPAC, and we got fully paid off. So it's, about things play off as long as there is inherent strength in the business, right? Similarly, we had another business which was in the B2B SaaS play. It was helping companies go discovered online very quickly, and it got acquired. It took like 6 months for the acquisition to take place, but for those 6 months, the company was only able to service the interest, right? It was a very difficult time for them to even, keep their employees on roll and keep running the business, because any strategic player takes its own sweet time. So those 6 months were very difficult. They were hardly servicing interest, but finally we got our entire, capital back with returns.
Okay, you've like I said earlier in the show, you've dispersed 1,650 crore over the life cycle. I think 100 deals plus, 100 plus deals. Correct. I don't know the exact number.
Correct.
And then several exits, and then 60 plus exits, right?
Correct.
My interest is now, you said India is still a market that you want to go ahead with and build a large. How much can you stretch it to? I mean, with the rate you're going at?
3-4 times of this easily.
Wow, that means your balance sheet will get bigger and bigger as
we have to, as in that is where our focus is. I don't know whether we'll be able to do it or not, but focus is that, because I can give another example. We have hardly focused on sales. Our entire team is focused only on execution. And whatever I executed, whatever number you mentioned, I executed this year, we got 7 times that amount of transactions into our system. 7x. And that is not even focusing outward and, going out and looking for transactions. Like on this call itself, you gave me possibly 5 deals, of which maybe one of them could be interesting for us. I'm just giving an example, right? So if you go out and really, really market well about, this is an opportunity for startups to raise capital from, maybe the number may become 5 times more, but the number of deals will also increase, right? So for us, growing alternative debt, because people don't get good quality institutions who can provide debt as per their requirement, right? They will give. Moment Vishal gives his house or he gives 30% as FD, then you will get debt. But that is not debt, right? That is like that is lazy lending, I call it.
Absolutely. And that's not, I would also say that's not scalable in many ways. I think you're building entrepreneur dreams. And I'm glad you also said that all entrepreneurs watching this, be it in college or outside, get to those 1 million plus in revenues And then magic happens with BlackSoil. You can dilute, of course, like Ankur mentioned, you need a VC. But if you want to drive your valuation up, work with the venture debt, grow your business even more, repay Ankur, of course, and then, raise more money.
Correct,
Right?
correct. It's
Ankur,
never been a better time. It's never
it's
been a
never been a
better time
better
to be an
time.
entrepreneur.
Absolutely. And in your case, you said earlier in the show that people today, entrepreneurs today, are far better than the quality you met in 2011.
Yeah. Correct.
One is, I mean, why would you say that it's gotten better? Is it because we understand compliance, regulatory better?
No,
Is that the case? Or is it because our
no,
dreams have gotten bigger, money is bigger? What
no.
is
I
it?
don't think not is that. First, when people used to hire for startups, they used to come from corporates alone. Now, when you hire for people, they come from startups itself. Startup guys are in startups, right? How many guys you would have come across? They have worked in 4 startups, 3 startups, 2 startups. So the DNA of a startup has been built, right? Especially like how a Flipkart guys can say, I have like 20 guys who come out and built big companies. So we have our own mafias coming up from various companies. Like Zoho is very famous for their own mafia. So that culture, that DNA that is you learn from a company. Like I have like people say I've been working city for the longest, so I have a city culture. Right? You build your inherent work ethics because like, that is where you build your entire DNA of how you run your entire career around. So that startup DNA has now become ingrained. Right? A lot of these students out there they're talking about will end up working for startups. They would not want to work for possibly the largest Fortune 500 companies. They would like to work for the potentially next Fortune 500 company. Right? Like in India, we have only 8% technology companies listed. US is 35%. We would all want that next 8 to 35% growth. You want to be part of those growth stories. And that is a different world. Now you have Amazon product managers you can hire for. You have people who can go hire for various social media kind of things. 10 years ago, they were not anybody to hire. Nobody knew anything social media. What is social media? We were not there on social media. So how these things?
2014, you are absolutely right. 2014, everything's changed, right?
So the people are aware of technology, digital very differently. So the crop is different altogether. These college
Okay.
students coming out will be very different from the college students came out 10 years ago, right? They were still thinking about Tally, Excel. They'll be talking about different kinds of products that they can use around, right? They can adopt technology very differently. So that's where. And the next point on that is serial entrepreneurs. Now you're having guys who have done business 2 times, 3 times, 4 times. They have shut down businesses, sold businesses, they have bought businesses. So that again changes the entire, vibrancy of the ecosystem.
I have so much to ask you in many ways. Would you say, in what way have you mentioned? You're a CFA, you're a finance professional.
I'm a CA, yeah.
Yeah, you're a CA, right? How have you changed? I mean, I'm glad we brought this up because I think finance is very undervalued. They look at CFO as all about cost cutting. But for me, it's strategic.
No,
Right?
it's not cost cutting. If it's cost
It is
cutting, then
strategic.
it's a wrong company. Then you are in.
Absolutely. I
Yeah.
completely agree with you. So what would you advise? I mean, now that you know the finance world, I mean, founders doing this, how should they make use of their money? Sometimes founders don't have a CFO function.
Correct.
Correct. And especially in the early stage when they get to say 7-8 crores of revenues, the
Yeah,
founders
yeah.
are handling it themselves.
Yep.
What advice would you give them?
No, I think it's very important to, as you had mentioned about compliances and all, something extremely important. I know about people who were running like just 4 transport vehicles, and they had dream of becoming an IPO. And those kind of companies are now actually a $1 billion company. And I'm not talking about startups today. I'm talking about something which is the traditional economy space. So if you are coming from the mindset that I want to run an organization of a certain category, so you have to take that also seriously. Of course, as a startup, always TDS returns, GST returns, always falls, back in time. You'll always be running behind. So finding those advisors, those CA firms, or there are so many external CFO agencies who can help you in compliance, etc. It's important because you don't want to be at a time when you're doing your fundraise and people come and open your books and you're like, boss, these are not books of accounts. These are like collection and payments account. It's like a ledger. It's nothing beyond that. So you don't want to be that situation. You want to be seen somebody who sees that this is going to be one day a public company. You have the foresight of that. You may not be one. And I'm not saying you put the cost of one. You have to be strategic in finding the people who can do that for you in a cheaper cost. Even when I started BlackSoil, we had only one accountant. It's not as if I had like a full battery of people. But that accountant is still with me, right? That's the beauty of these guys. They're extremely loyal. If you get a good one who understands his work and you keep giving them good quality work, they will be with you for a very long period of time. And I think most companies, if you ask, most of the accountants will be there with you for a very, very long period of time. And you can hire these guys. They are not very expensive. It's about priority. priority cannot always be fundraising.
Correct.
Compliance is also important. So it's about you giving little bit of time to understand it. And if you can't understand it, find somebody who can do it for you. And finally, you can focus on business. But one thing I can tell you, I have seen companies where founders don't understand finance, but they're commercially so strong, they know better than the finance people.
Okay, because they've been selling. Because they've been selling.
They're selling. They're collecting. They know their business inside out, right? So nobody can take them for a ride. So finally, it comes bottom line, down line. If you know your business, you can tease a finance person also what they're looking for. So you need to have a good finance. You can understand what the CEO is looking for, what the founder is looking for, and help them prepare their accounts or business or MIS or plan accordingly.
Okay, I want to know, when you were a college student, now how time has flown for all of us. You know, we're older, much older. Things are different now. No, I mean, I want to bring this in saying the students today have much more opportunity than what we did.
Correct.
Right? Do you want to talk about that and how different they are? Do you meet young entrepreneurs?
I think I started meeting a lot of young entrepreneurs. Then suddenly in the last few years, we are only meeting entrepreneurs who've been like, people with 10 to 30 years of experience. So unfortunately, I've not met very, very young guys recently. But if you meet anybody between 25 to 30, if I take that as a benchmark, I think the word that some of my VC friends or my other startup founders use is they are sorted.
Yeah, 100%.
They're sorted in their mind. They know what they want. They know how to go about it. They know how to, go execute it. And they know what they are looking for. They're more sorted than maybe what I am today also, right? So they know how to go and execute it. And that's why you have some of these likes of Pharmacy founders and all who have had the benefit to, interact, even OYO founder. These guys are at a different level, right? You are like shocked that you are maybe 15 years more experienced and they know how to talk to you also. I don't think at 25 would even talk to anybody, right? These guys can go network, they can go pitch. They know what is so many things that you can't even, you're still realizing and learning for, right? Like today, for example, on this call, I'm sure most people would know about crypto more than I do.
100%.
Right?
100%.
So that's a very simple example.
More than what both of us know. Yeah, about crypto for sure.
Correct.
I want to know, when you funded OYO, but what stage did they come to you? He was young?
Yeah, he was young, and we had funded when they just raised almost 100 million 6-9 months ago. So after 1 year of our funding, they raised the $1 billion round. So it was in the middle of that 2 different phases of life.
So that's amazing. So young people today have dynamic, and you're saying there's some twinkle in the eye for every Indian entrepreneur out there. And
yeah. I think
you're in a nice space. It's a different asset class.
Correct. And I'm very happy to be part of this business. It just happened to be there. It's not as if anybody had some strategic insight about it. Just happened to be there at the right place at the right time.
Okay. Do you think universities should lead the race towards entrepreneurs? I want to ask this because in the US, a lot of the innovation comes from university. Do you think there should be a funding model where they raise equity from the university and also do business, and probably you can come up with products for them to grow to? Is there a model that you thought of?
Not on debt, but on equity side, already I see an IIT and all, and IIM guys. These guys have been funding their startups, left, right, and all the time, right? You see CN, if not the right word, SINE. These guys have been active across their portfolio companies. And I think what you're doing in this college as well is very good, right? Because everybody should think about doing things, making things. I think in Indian DNA, it comes very naturally because we are Jugadu people, right? It comes very naturally to do business. Many of the people around us have done businesses. So it comes from so few people, it comes very naturally. So it makes sense to college to foster the innovation kind of a mindset. So even it doesn't need large money, right? Today, money is very easy to get. If you have a good idea, you can go tomorrow to a Microsoft startup cohort or a Google cohort, and there are so many college cohorts also happening. There are so many angel networks running college student cohorts, so you'll be able to get capital. I think capital is least of the worries. Getting the right idea and execution is what matters today.
Okay, our last question. What are you reading that can help kids? Are you reading at all, or would you say if you're an entrepreneur, read but also go sell? Don't stick in theory of entrepreneurship.
I think reading will only help you to know about the product and the system you're in. You have to go meet people. I think the more you're out there, meeting people, exchanging different kinds of ideas with different kind of people, the more you network. It's all about network. I think our business, our life, every day I realize more than earlier, the network decides where you're going to be in life. You can be the best guy, but you don't know whom to talk to or whom to sell to. Or you do not know is there somebody out there who can advise you. Now, what's the point of that, right? You can't be a lab rat as such. So unless your business is that, but you cannot be sitting in a silo. In today's world, you have to be out there. And I think all the organizations, all big corporates are open to meeting people, right? So there are enough stories out there. If you are inspired, you don't need to be feeling inspired. Like if you need a book to feeling inspired, then anyway, it's not meant for you. It's about you're already inspired. You don't know what to do. You go out in the world, you meet people, you find problems. Problems are in your backyard. Everybody's focused on Bharat problems. It's not as if people want to solve for tier 1 problems. So you don't have to go anywhere. It's there in your backyard. So you don't have to go anywhere to find a problem. And then you have to find the right-minded people you want to work with. So it's you can be 22 years old, have already worked in 3 startups by the year 27, right? Possibly. And then you can do your own company. It's not like time is running away. It's about doing the right thing at the right time with the right intention. So I don't think that should be a challenge.
Ankur, I'm going to get back to you real soon, and definitely for another podcast, because we've only scratched the surface of BlackSoil. There's so much more to talk about. But thank you so much for inspiring students to start up. Thank you for the PES University, PESU Venture Labs, and CoCreate for hosting this. And we'll see you all soon. Thank you, Ankur.
Thank you, Vishal, for having me. Thanks everyone for listening to me. Look forward to connecting, and feel free to reach out for any ideas, etc. you feel I could help in any way. Thank you, guys.
BlackSoil, what's the website?
BlackSoil.co.in.
That's it, guys. Go check it out, okay? And there you go. Like Ankur said in the beginning, venture debt and equity, which is venture money, still go together. So you'll be fine. So go understand what BlackSoil is about and write to Ankur. Thank you, Ankur.
Thanks, Vishal. Thank you.
Bye-bye.
Bye.